We thought today we could talk about Warren Buffett and why he thinks earnings per share is overrated. So, what are your thoughts on that to kind of start our conversation today?
Yeah, that's a cheeky start, isn't it?
Yeah, a
Warren
little bit.
Buffett calling earnings per share overrated. And I think that he has an excellent argument on his side. But I think the reason this is an important topic to call out is that if you watch financial media or if you just watch headlines from companies reporting earnings, what gets all of the focus and all of the glory? Earnings and earnings per share. Did it grow? Did it beat expectations? That is what the financial media hyper focuses on. It makes sense because it's a number that reflects the profitability of a company. Is it growing? Is it shrinking? However, in Buffett's 1979 letter to shareholders, he made a pretty compelling case for earnings per share not being the primary thing that you focus on when judging how well a company is doing.
So, what is the thing that he suggests you focus on?
So, according to this letter, Buffett essentially said that earnings per share is important or should be looked at, but if you only focus on earnings per share, what you are effectively focusing on are the output of a business, right? The thing that comes out of the business. But just focusing on earnings alone ignores what went into the business to create those earnings per share. So Buffett says that actually, rather than solely focusing on earnings per share and output of the business, Buffett wants you to focus on the ratio of what went into the business to what comes out of the business. And he there is specifically talking about the return on capital that the business, or more specifically the management team, gets from taking the capital that was put in and using that capital to create the profits.
So, how can we measure that ratio? He throws around return on equity and return on capital a lot. So maybe we could talk a little bit about both of those.
Yeah, there's actually multiple ways to measure what kind of return on capital a business is generating. And this is something that personally I struggled with for years. Like, the math behind these numbers or these terms is not hard. It's very, very simple. It's just very simple division. What I personally struggled with was why this was important. Like, why this is a thing that investors should focus on at all. Because it's very easy, for me at least, to be like, okay, earnings per share times PE ratio equals stock price, right? And that's the thing that I care about as an investor, is what happens to the stock price. Return on capital equations don't always relate to the company's stock price in the future. So it's more of an ethereal connection between the two to focus on. But to answer your question, there are four primary ways of measuring a company's return on capital that are fairly popular. There's more than this out there. I mean, there's lots of ways to calculate this, but there are four primary ways. So return on invested capital, ROIC, which I know you guys have covered on this show a lot, and I'm glad that you do. Number two is return on equity. This is the one that Buffett himself has been kind of beating the drum on for the last 40 or 50 years. I have a hunch, though, if you were to ask him about this today, he would say that this number is less important because it's the easiest one for management teams to manipulate, or it's the most likely to be way off of giving you useful information. Then there's return on assets, which is primarily useful for measuring very capital intensive businesses like banks, insurance companies, or industrial companies. And then the fourth one is return on capital employed, or ROCE. But using, I would say, all four of these return on capital ratios in conjunction with each other can actually give an investor a better idea for what kind of returns businesses are generating with the capital they have.
Yeah, those are good. So do you have a favorite out of these?
So if you forced me to pick a favorite, I would probably choose return on invested capital, ROIC. So the formula there is net operating profit after tax, or NOPAT, in the numerator, and then average invested capital in the denominator. And what this shows you is what kind of return, or what the interest rate is, if you will, that a company is getting from deploying the capital that it has. So companies, generate or raise capital from investors and from lenders. They deploy that capital. They use that capital to buy or build assets. Those assets then go on to create profits, which there's many ways to measure profits. So it's really the ratio of what profits those assets generates to what capital went into creating those assets in the first place. Of the four, I think that ROIC is probably the most useful and the hardest to manipulate. So it's most likely to give you an accurate representation of the return on capital that a business is getting.
So if we could back up for a second, you mentioned something I thought was fascinating. You said you kind of had this aha moment about, okay, I know the math, but this is why it matters. Can you walk us through that part? Because I can see a beginner investor saying, you know what? If EPS is up and stock price is up, I'm happy. Who cares about anything else? But obviously there's more to that than this. So can you walk us through that enlightenment that you had in the past?
Yeah, what really helps me is to put things in as simple terms as we possibly can. So what really turned me on to this concept was when I thought about, went through this exercise with investing in a bank account. So Andrew, pretend that I gave you $1 million. Congratulations!
Okay. I like this. I like this start.
I like where this is starting. Can I get in on that too?
So I give you this $1 million, and I charge you 5% interest on this $1 million. So you have to pay me $50,000 per year in interest. So you take this $1 million, you go down to your local bank, and you put that $1 million into a CD, a certificate of deposit, that pays you 3% interest. So $30,000. Is that a wise financial move for you? No, right?
Absolutely.
You're paying me 5% interest, and then you're earning 3% interest. So effectively, what you're doing with this investment strategy is you're destroying $20,000 in value every year. I think everybody listening can understand that concept. Now, let's pretend that I'm happy with this arrangement. So I say, Andrew, here's another $1 million, right? $2 million I'm now giving you. And I'm charging you 5%. So I now make $100,000 per year. That's the cost to you. You invest that extra $1 million at 3%. So Andrew, you've now doubled your earnings. You were earning $30,000 per year. Now you're earning $60,000 per year, right? So if you were running a company, you'd be like, I need a bonus. I just doubled the earnings of this investment. But of course, was giving you more capital a good idea? No, you are now destroying $40,000 worth of value every year. So if you understand that concept, you can apply that exact same logic to a business. So how do we figure out the cost that a company should be charged for raising capital from investors and for lenders? There's lots of ways to answer this question. The academically correct answer is to use weighted average cost of capital, or WACC, and you take the charge of the equity, the charge of the debt, you weigh them appropriately, and you get some number. Let's just throw a number out there and just say 8%, right? Let's just say a company has an 8% average cost of capital. Well, if it's cost the company 8% to have access to that capital, the company has to then take that capital and earn a return on it that's higher than 8% in order to create value. Mm-hmm. If the company invests that capital and earns 8% or less, it's destroying value. Even if earnings are growing, if the company isn't earning at least an 8% return on this capital, then that is a terrible use of capital. That company does not deserve to have the capital that it has. So this is why Buffett says, don't look at just earnings per share. If a company is raising more capital, it should be growing earnings per share. That's not impressive, right? The company could be investing in a savings account and growing earnings per share with zero skill. What matters is how much capital they raised in proportion to how much earnings they're actually generating with that capital.